All right, welcome to the Explainer. Today, we're jumping right into the question that seems to be on everyone's mind. What is going on with all this bearish pressure on the S&P 500 ETF? You know, the SPY. We are going to break it all down, look at the data, see what the pros are saying, and figure out what's really happening. Have you felt it? You know, that little knot in your stomach lately when you check the markets? That tension in the air? If you've been feeling even a little bit nervous about where things are headed, trust me, you are not the only one.
Okay, so let's just cut right to the chase here. The big takeaway from everything we're seeing is that right now, the market sentiment is clearly, and I mean clearly, bearish. So for the next few minutes, we're going to unpack exactly why that is, looking at both what the experts are saying and what the cold, hard data is telling us.
First up, let's talk about the narrative. This is what you're hearing, right? The headlines, the warnings, all that chatter coming out of the financial world. This is kind of the first layer of the onion.
So analysts are basically pointing to a trio of major risks. First, simple overvaluation. The S&P's price-to-earnings ratio is floating around 22.5, which, if you look back at history, is pretty darn high. Second, you've got this growing fear of a speculative bubble, and the concern is spreading out beyond just the big tech names. And finally, the big picture, the macro data. It just looks kind of shaky, with weak reports on jobs, inflation, and growth really making everyone tap the brakes.
And look, this isn't just people talking. This is people putting their money where their mouth is. Take this quote from Kevin Muir. "We are starting short positions. The risk-reward is unattractive." Wow. That's a powerful statement. He's not just saying be careful, he's actively betting that the market is going to fall because the potential reward just doesn't justify the risk anymore.
And that bubble talk, it's being echoed by some huge players. I mean, when a massive global bank like HSBC tells a major outlet like Business Insider that it's seeing signals of a possible speculative bubble, well, yeah, investors are going to take that very, very seriously. That's the kind of headline that can really shift the mood.
This quote from Barron's just perfectly sums up the puzzle everyone's trying to solve. The market is stuck between good earnings and bad data. It's like this giant tug of war, right? On one hand, a lot of companies are still turning great profits, but on the other hand, the wider economy is looking pretty troubling. This conflict is exactly why we have to dig deeper.
So let's get to it. The verdict from the data. This is where we see if the hard numbers actually back up all this cautious talk.
And the short answer is yes, they absolutely do. The data from options and volatility pretty much confirms this cautious mood. So let's start with the market's famous fear gauge.
We have to talk about the market's famous fear gauge, the VIX index. It's simple, really. When the VIX goes up, it means investors are expecting turbulence, and they are paying more to protect themselves.
And just look at this. The VIX recently shot up over 21% in a single day. That is not a gentle warning sign. That is a massive, attention-grabbing, flashing red light of fear.
Now, to put that into perspective for you, a move that big is in the 98th percentile of all daily VIX increases. That means it almost never happens. It's an extremely rare event that tells you investors made a sudden, dramatic rush for the exits.
A spike like this also brings a scary technical risk into play, something called the gamma flip. The easiest way to think about it is like a tripwire for the market. Once the VIX crosses a certain key level, around 18.1 in this case, it can trigger a wave of automated selling. That selling pushes the market down, which creates more fear, which triggers more selling, and you see where this is going. It's a dangerous feedback loop.
So where's the actual money flowing? Let's follow the cash. This slide on SPY options is incredibly revealing. On the left, you've got puts. Those are bets the market will fall. On the right, calls, bets it will rise. Now look at the notional value, the total dollar amount being wagered. Over $7 million on the bearish side compared to less than $4 million on the bullish side. And the open interest, the number of active contracts, tells the same story. Twice as many bearish bets are open right now.
And this bar chart just makes it crystal clear. That taller bar for puts completely dwarfs the bar for calls. The message from the options market could not be any louder. The big money is overwhelmingly positioned for a drop, or at the very least for protection against one.
And get this, the pressure isn't just from outside sentiment. It's coming from inside the S&P 500 itself.
An incredible 2/3 of the 50 most important stocks in the index are projected to fall. And we are not talking about small fry here. We're talking about the heavyweights: Microsoft, Nvidia, Meta, even Berkshire Hathaway. When your biggest players are dragging the team down, it's hard to move up.
Okay, so after looking at the headlines, the fear gauge, the options market, and the index's own internal health, what is the final verdict for SPY?
It really all boils down to these 4 key drivers. 1. The options market is playing defense, with way more money betting on a drop. 2. Fear is spiking. The VIX shows investors are scrambling for cover. 3. The experts are waving red flags about valuation and the economy. And 4. The index is fighting internal pressure from its own biggest members.
So when you connect all those dots, the picture becomes, well, pretty undeniable. Both the street-level sentiment and the hard market data are pointing toward a potential drop for SPY. The case for all this bearish pressure is just really compelling.
And that leaves every single investor with the million-dollar question, doesn't it? Is this the start of a necessary correction that's going to bring valuations back down to earth? Or is this all just temporary noise in a market that's still fundamentally strong underneath? That's the big question to think about. Thanks for joining us on The Explainer.
Si te interesa seguir recibiendo este tipo de análisis y estar al tanto del movimiento de los mercados, te invito a que te suscribas al canal, dejes tu comentario con tu opinión y apoyes este contenido. Nos vemos en el próximo video.